For most people, home ownership will be the most important investment of their lives, so it pays to know something about how mortgages work. Imagine take out a loan for $200,000 to purchase your first home. The interest rate is the percentage of that loan you pay to the lender for the privilege of that loan, and its term, the duration of time. Rate and term interplay to yield different totals. So first example, 6% over 30 years. The interest, or the total amount you've paid to your lender during that time, over $250,000. Plus, you still have to pay the house itself, so together, nearly $500,000. Now, if we drop down to 4%, same amount of time, substantial savings. And people think 4%, 6%, what's 2%? That's not much. Well, large sum of money, long period of time, the difference is significant. Or if the interest rate were to stay the same, paid off more quickly, and great savings that way as well. And of course the ideal, shorter term, lower rate, most savings. So that's the ideal, and the real is what most people end up paying. With that overview, let's delve a bit more deeply. Here are two key terms. Interest, blue, is the profit the bank is making for the benefit of loaning you the money. The principal, red, is the money going into the purchase of the house itself, which the bank technically owns until the loan is paid in full. This algorithm is a perfect ratio where interest goes down while principal goes up proportionally. This way, your monthly payment remains exactly the same throughout the duration of your fixed rate mortgage. So, what makes mortgages so costly? You know someone who's very wealthy, and that person wants to buy a new toy, and that toy costs the same as the house. But this person's wealthy enough to pay for it in cash, and the tax for that Lamborghini will be about $12,000. In contrast, go to a cheap burger joint, and your tax on your meal is pocket change, in contrast to tax on a Lamborghini, which is enough to buy a used car. Like sales tax, my 6% interest on a $200,000 loan would be $12,000 the first year. So that goes to the bank, and just under $2,500 goes toward the purchase of the house. However, sales tax is one and done. So here's the difference maker with interest. Subtract the amount that goes toward your home, and now the second year I pay interest, like another tax, on the $197,000 remaining. After just 2 years, I've given the bank nearly $24,000. Furthermore, the average homeowner keeps a home for 10 years, which for a 30-year loan is a horrible money pit. After a decade of paying the bank, only $32,000 went toward the house. You still owe the bank $168,000 plus interest. Over the same time span, you've given the bank over $111,000. That's roughly $11,000 a year for 10 straight years. As noted in an earlier slide, shorter terms and lower rates equal great savings. For the same $200,000 loan, only $8,000 would go to the bank the first year, and a greater amount goes towards your home. Sell the house in 10 years, and by then you own 60% of the home, and you've given the bank about half of what you would have given it with a 30-year loan. Again, these are dramatic comparisons to make a vivid point. Let's move on to a more realistic scenario. The combination of rate and term ultimately determines how much you can afford to pay monthly. In reality, the market drives interest rates, so you have little control over that. What you do have control over is duration. Comparing these three examples, obviously the faster you pay off the loan, the more costly the monthly payment. Look over on the right-hand side. Not many people would be able to afford a 10-year mortgage. However, comparing a 20-year versus a 30-year loan, the difference often is within reach, and the savings is significant. If you keep the house for the duration of the loan. And if you do, you will have finished paying off your house 10 years earlier, so that's additional income going forward. Of the tens of millions of people who get a mortgage, statistics reveal that 90% will get a 30-year loan. Sadly, in many cases, people opt for the 30-year loan based solely on the bottom line, the money they can save each month. But often they fail to realize the big picture savings. The truth is, quite a number of folks who take out a 30-year mortgage could afford a 20-year loan. Now we come to the part where some of you watching this may benefit the most. Let's say you can afford a 30-year mortgage, yet a 20-year mortgage might be tight. Well, the last thing you want to do is default on your loan and risk potential foreclosure. So here's a conservative approach. Buy the 30-year loan, then voluntarily add the difference to your payment each month. This is referred to as paying down the principal, and it has the identical benefits as if you took out a 20-year mortgage, including those benefits mentioned of selling your home within 10 years. Best yet, if things get tight and you need the extra cash, you're under no obligation to pay that difference. So when it comes time to shop for a home, do your homework, understand some important terms, and you'll be better prepared to shop. Understand what private mortgage insurance is. We just covered paying down the principal, the difference between a fixed and variable interest rate, and when one might be better than the other, and what it is to pay points. Quickly, that's like taking my 6% example in the beginning and paying up front a little extra money so you can drop it down to a 4% interest rate. So you pay up front but save over the long term. And happy house hunting.